Being able to buy an index directly would be extremely convenient, but it's not possible. The investing world, however, has figured out a solution that is as close as you could possibly get. That solution is called an exchange-traded fund, or ETF for short. Here's how ETFs work in a nutshell. Certain companies, usually large banks or specialized asset managers, look at a given index to see what its components are and how it's weighted. Then they create a fund made up of the same companies in the same ratios, essentially replicating the index manually. The ETF creators then turn around and sell shares of that fund on popular stock exchanges, hence the name exchange-traded fund. Now, these shares function exactly like the shares of a regular company. You can buy them in your own brokerage account and you receive whatever dividends the ETF's underlying companies issue. But there is a catch. The ETF creator isn't doing all of this work for free. Maintaining an ETF is a very challenging endeavor, which is why the ETF creator charges an annual fee for providing the service. Luckily, the ETF industry is highly competitive, and so these fees, better known as expense ratios, are usually very small. Your typical ETF expense ratio is somewhere between 0.2% and 1%, but the more popular ETFs can go as low as 0.03. The most popular ETF, which is also the oldest one, unsurprisingly tracks the most popular index, the S&P 500. In 1993, State Street created the Standard & Poor's Depository Receipts, or SPDR for short. In less than 3 decades, the SPDR has become the most traded asset on the planet, with an average of 87 million shares changing hands every day. Buying a single share of the SPDR will cost you a couple of $100s, but it will give you exposure to the 500 biggest American companies. For comparison, if you tried manually replicating the S&P 500 yourself, you would have to buy over $13 million worth of shares to accurately maintain the index ratios. In other words, the convenience of ETFs is very much worth the small annual fees they charge you, and today ETFs are the backbone of investor portfolios. But of course, there are numerous other asset classes investors can buy, beyond the stock market and individual companies. The beauty of ETFs is that they can be applied to almost any asset class out there, and within your one brokerage account, you can gain exposure to stocks, bonds, commodities, currencies, and even real estate just by purchasing shares in ETFs. But all these topics are for another time. I'm sure you agree that each of the asset classes I just mentioned deserves its own series of videos, but for now, I think we've done a good job covering the basics of how the stock market works. Thank you for joining me on my first class here, and if you were left with any unanswered questions, please mention them in the comments. I would be happy to answer them. And of course, if you enjoyed this class, feel free to share it with your friends and family if you think it would be useful to them. Once again, thank you for watching, and until next time, stay smart.